Hello, it's Wednesday, December 17th, 2025. This is Michael Harris from Markets and More, and I would like to talk about the unemployment rate and Fed policy. What you see here is the top chart is the unemployment rate, 4.6%. You see the average since the 50s is about 5.7%, and the low on April 2023 was 3.4%. Let's look at the rate of change since the low on April 2023. It's 35%. The change of the rate of change of the unemployment rate. So what you see in the bottom chart is one sigma band of the rate of the 30-month rate of change and the Fed funds rate. As you can see here, every time unemployment crossed the average, also crossed the one standard deviation band. So this is what is happening. They know this. There is momentum. When unemployment starts rising, it will rise higher. It's a process they know. So every time you see these dotted lines, they cut. The problem is in the 70s and in the early 80s, they cut and then they raised rates again. This was due to the energy crisis. During that time, the war in Middle East and then the embargo, the oil embargo and the high inflation. But after the 1980s or since the 1990s, monetary policy has been fairly, I wouldn't say easy, but it didn't have the complications of the 1980s and 1970s. You see here in the early dot-com crash, the unemployment, the 30-month change crossed the average, and there was a cut cycle. And the same in the mid 2000s, and then during COVID period, and this is the current situation. We have this cross above the average of the 30-month rate of change of the unemployment rate, I repeat, and they are start cutting. Well, the fear is it's a remote possibility. They will have to raise rates again as they did in the 70s, mid 70s. You see they cut here the Fed funds rate. By the way, it has its own scale. It's not shown just to the overlay. And then in the early 80s they hiked again. And then you see the spikes here in the mid 1980s. They cut, and then they had to hike the rates again. There was a lot of volatility in the 80s due to the ripples of the high inflation period. We don't have the same conditions now, and monetary policy, it's easier, but I will write something on Substack about the dual mandate. Okay, so this is the situation now. There is a cutting cycle. Unemployment will rise based on historical standards, but I want you to remember this always when we are talking about analysis, because also macro analysis has embedded technical analysis. Lots of people look at moving averages and rate of changes. This is basically technical analysis, and the rest is word salad sometimes. So these are small samples, so we assume the present will be similar to the past, and we will have and unemployment here will the rate will go toward its average, but you never know. Maybe there is a regime change. We will find out. So I don't like absolutism, the kind you find in some macro newsletters. So no one can predict anything based on these changes in Fed funds rates and unemployment and all these variables, because there is high unpredictability and regime changes. So the best way to invest or trade the markets is through systematic approach. Thanks for listening and watching the video. Have a nice day.